Good one. Shall we start? Are there any more to come? Morning. Is there any? Sorry, 36, 8:36. Just started. We have to discuss something financial market. Right. Good morning. I think you may remember I asked you to come with the reading for the financial market. So I was bringing 30 minutes like time for that because I went to the reading and come with some of the reading. The next week we will have partial results in and then reduction. So did you had the reference assigned? Thank you. So let's say I will brief, right? Still, it's your responsibility for the within this area because no point of teaching the financial markets and environment here because I want to start the time value of money today. I will brief something related to the financial environment and financial markets. This is a very brief outline, as I told you at the previous day also. Outline, so you will learn what is financial system, what is the role of financial system, why it is important. So we discuss financial system in Sri Lanka here, but you should know the financial system in the global context also. So that is related to the global financial environment. So you will learn under the financial system, main components of financial system includes financial institutions, financial intermediaries, financial infrastructure, then monetary or the regulatory authorities. So likewise, these aspects you have to read related to the Sri Lankan financial environment. So if I define the financial system, so you know that when we say a system that is interrelated, interconnected components, system mean they are interrelated and also they are interdependent, interactions are there. So in the financial system also is a structure that consists interrelated and interdependent components. Interrelated and interdependent components. So what are these components in our Sri Lankan context? Our financial system, it includes financial market, intermediaries, instruments, infrastructure, regulatory authorities, central banks. So likewise, these are the components. So what is the main role? What is the main function of the financial system? Is the intermediation. Intermediation. So intermediation means very simple term, transferring funds from the surplus units to the deficit unit. That is the intermediation. So if you take a bank, so they are doing the intermediation. If you take, say, instruments like fixed deposit, that is also an instrument that is we are using for this financial intermediation because when I have some extra money, I put a fixed deposit. So bank using this money to provide a loan for the required another party. So that is the intermediation. So that is the main role, main job of financial system. So you can use the one term for that, financial intermediation. Right. So that is the role of the financial system. So then not limited to the Sri Lankan or our financial system, you have looked at the global financial environment, global financial market, developments in the global financial environment. So you can go to the, as I included here, there are certain web pages as well as the links, web links I have given. So you have to look at them and you can have some understanding about the happenings in the global financial context. You can go to the International Monetary Body and the Asian Development Bank, so like the main institution in the global financial environment. So that is also required to read. So that is why I am planning to have your group assignment on this area. So I will give you the certain topic with the detailed outline. So you have to read them related to these aspects. So you have to have certain knowledge and you have to have a presentation. So then you will read that. Otherwise, I know that you are not reading. You are very, very, very reluctant for that. I know. Listening is okay. But anyway, when I do some reading and so kind of thing, you are very reluctant. But you are in the Facebook, Twitter. So we are using that one. But anyway, you are not like to go to the central bank website to read the financial system instruments. I know that. That is the nature of the students. Right. Anyway, this is also included financial environment in the global context. So these are the main components of a financial system. Central bank as the apex financial institution, that is the governing body of the financial system, they monitor the commercial banks, specialization bank, financial institutions, liquidity of the financial market. So therefore, that we identify this central bank as the apex institution in the financial system. And also financial markets. So I will briefly explain these financial markets, money market, capital market. So likewise, financial instruments. You know, these financial instruments. What are the available instruments? And also the financial institutions, like not only the banks, insurance companies, uh, institutions like finance companies, primary dealers, stock brokering companies, money brokering companies. So likewise, there are list of institutions in the financial system. They also doing this that job, financial intermediation. Main job, financial market, financial instruments, institutions, all they are supporting for what? Intermediation. Surplusing, transferring funds from the surplus units to the deficit unit. And infrastructure. So to run this financial system smoothly, right? So to function this smoothly, there should have some technology, platform, system. So these all the things related to this system and whatever the technical or the technological know-how will come under the financial infrastructure. So there is online payment system, check clearing system, real-time gross settlement system. So likewise, certain systems are there related to our financial system. All these come under the financial infrastructure. So these are the components of our financial system. So in Sri Lankan context, our financial system consists with these components. So you should have a knowledge about each of these components, right? That is expected. So if you go to the financial institutions, or we call intermediaries, you can see these are the available financial institutions in Sri Lanka. All this content, all these things I have ordered from Central Bank website. So if you go to the CBSL website, you can see all these things are there. So that is why last week I asked you to come with the proper reading. If you go to the cbsl.lk, I will show you. I think there is internet here. This internet is there. So if we go to this website, cbsl.lk, this is the Central Bank of Sri Lanka page. So you can see all the information related to the financial system. So this is the most appropriate thing that you should read: financial system. Financial system stability. It's not sharing. Anyone is there who knows how to share the main desktop in the main theme? Desktop sharing. Sharing so that we can have I want to Excel also. Virtual. Let's can see. Then Fine. So if you look at this web page, so you can see this is the mandatory reading as I told you the previous day. I'm not taking more than time for here for that. So if you go to this financial system, all the links are there. Financial system stability, financial markets, financial infrastructure, instruments and their implementation, and everything. You can access through whatever the language you wish. You can access through English, Tamil, or Single. So that is must you have to read. So I have prepared this PowerPoint presentation even based on this information included in this CBSL website. So therefore, by reading, you will get this understanding further. So it is mandatory, compulsory thing for reading this one. Right. So these are the institutions in the Sri Lankan context, listed banks, listed specialized banks, finance companies, leasing establishment, microfinance companies, dealers, primary dealers, authorized dealers for the foreign exchange currency, money brokering companies, authorized money authorized money changers, money brokering companies. So likewise, these are the financial institutions. So I'm not going to explain one by one because if you take licensed companies in Sri Lanka, how many licensed companies are there? Okay. Yes. Right, so you have to read them, right? So I'm not going to explain. I want to show you them in the central bank website, but anyway, it's not visible for you. So the next one is the financial markets. So financial markets also facilitating intermediary function, financial intermediation. So when we say the market, actually in the traditional time, the market was the place where the buyer and seller meeting. So likewise, but now market is not that light. So you can see virtual markets are there. Market can be an email, some fax message. So likewise, kind of a developments and the involvement is there. So market mean where any status, any type that buyer and seller meet. Matter, yeah, make it in that. You can context and make it Right. So market is the place where buyers and sellers are meet for any when it's come to the financial market, especially for the buying and trading for the financial instruments like bonds, debentures, equity shares. So likewise for the financial instruments. So this is the definitions for the market. So market you can categorize based on the different characteristics. So you can see different classifications or categorization are presented here based on the term to maturity, right? A term to maturity means actually the term to maturity of the instruments traded in this particular market. If the instruments traded in the particular market, if their maturity less than one, if instruments traded less than 1 year, so that is we call money market. So like say savings deposit, treasury bills, short-term fixed deposits, their maturity is less than 1 year. So the instruments traded with the maturity less than 1 year come in under the money market instruments or the money market. So money market is the place where the short-term instruments are traded. Capital market is the place where long-term financial instruments are traded. So like debentures, bonds, fixed deposit more than 1 year, treasury bonds, equity shares. So likewise, they are the instruments traded long with the long-term maturity. That is more than 1. So that is based on the term to maturity. Term to maturity. And also you can categorize markets based on the generation of financial instruments as primary and the secondary market. So when company issuing shares for a first time, we call it as an initial public offering, IPO. IPO. So that is primary market. That is based on the generation of financial instruments. If it is if that particular instrument, if it is traded for the first time, so that is the place we call primary market. After the first issue, then this instrument can be traded between the investors. So that market we call secondary market. So that is classification of the financial market based on the generation of the instrument. If the instruments or this financial instrument, if it is traded for the first time, if it is an initial public offering, so that is primary market, right? So then if I ask a question, for the treasury bills, where are the primary market? Treasury bills, treasury bonds, like government securities. Now if we take the equity share, primary market is the place where the companies, when they do the IPO. In the primary market, directly cash flow is received into the company, right? But in the secondary market, there is no any cash flow to the company. In the secondary market, instruments are traded between the investors. No any company involvement, right? So then when it's come to the treasury bills, where are the primary market? When primary market, now you know what is primary and secondary market. So when you consider the treasury bills, at which point the primary market is open? You know that if you are going to invest, if you are going to have interest, or if you are going to invest in the treasury bills, directly you can't purchase, directly you can't invest. So you have to go to primary dealer. There are special institutions or special companies for this primary as the primary dealers for facilitate the trading of the government treasury bonds and treasury bills. So in the primary market is there. Normally, that you know that on behalf of the government, central bank is issuing the treasury bills, treasury bonds on the options. So then primary market is covered. At which point? Treasury bills primary market is, and the treasury bills secondary market there. Now, if you take the ordinary shares of the company, primary market and secondary market is very clear. Primary market is where the company, when they issue the ordinary shares at the first time. So that is its IPO. Secondary market is where in the Colombo stock market, this company share is traded in between the investors. You may buy, you may sell, another investor will buy. So like it's traded. So that is the place, secondary market. When it's come to the treasury bills, they are the primary market, they are the secondary market. Primary market and secondary market. Primary market is the place where private dealers are going to the auction, so they collect the shares on behalf of the investors. That is the primary market. After long say, I have invested in the treasury bills, right? On behalf of me, primary dealer went to the auction and he purchasing some treasury bills for me. So that is the primary market. So after now, I have certain treasury bills. If I want to sell them because I need some money, there is a emergency. So then if I want to sell this treasury bills, so I may go to the secondary market of the treasury bills. So then I may sell them at a discounted price again. Maybe the primary dealer or maybe another investor can purchase through again primary. So that is the secondary market. Right? So when it comes to the bonds, debentures, they are the primary market and secondary market. You know that? Bonds and debentures are both same debt instruments issued by the companies, listed companies. Private market is there. Again, when they issue the bonds and debentures for the first time, that is its IPO, initial public offering. After that, you might have seen the advertisement. Some companies are when they do it, when they are. I think very recently there was a bond on the debenture issue for the BOC. Anyone is not back of the debenture issue was there very recent. So then I can apply. For using that application is there, I have to go to the relevant bank and then I can forward my application to industry that companies of the BOC debentures. So then I may awarded certain number of debentures based on my investment. So that is the final one. So after that, now I have 5,000 bonds, debentures of the BOC. So then if I want to sell it to you, then I am going to the secondary market of the debentures. So I have to sell them at the prevailing presently current market price. So that is the secondary phase. So for each of the instruments, you have to be able to identify primary transaction and the secondary transaction. So you have to remember in primary transaction or into primary market, always cash flow is receiving to the issuing bond. Buyer and the issuer directly meet in the primary market, but in the secondary market, company is not involved. Company is not involved, so any cash flow may not be received to the company. So therefore, we call primary issue or the primary market as the direct financing. Direct and the secondary market transaction we identify as indirect finance. In the direct financing, issuing company directly getting the cash. But in indirect finance, company is not receiving any cash. Right, so you have to read, right? Then you can, again, financial market you can categorize based on the nature of the financial instrument. Based on the nature, whether it is a debt instruments or the equity instruments, debt or equity. So if it is a debt instrument, you can identify them as a debt instruments market. If it is a equity instruments, so that is we can categorize under the capital market. So the difference between here in the debt capital, sorry, in the debt market, instruments are traded with having fixed income. In the debt market, all the instruments which are traded are having fixed income. Now, if you take the bonds, you will get the fixed coupon. If it is a fixed deposit, you will get the fixed interest. If it is a preferred share, you will get the fixed dividend. So, instruments with fixed interest, dividend, or any fixed income. So we identify them as a debt securities. With the fixed income, from your investor point of view, it is for you a fixed income. From the company perspective, it is a fixed cost to the company. Because investors are receiving fixed dividend, fixed coupon, fixed interest, that is their fixed income. From the company perspective, it is fixed cost to the company. Right? So in the debt market, in the instrument, you can see the instruments are trading with the fixed income. In the equity market, you can see capital market instruments. So in the equity market or the capital market, you can see the instruments which are trading with the variable income. Examples for the instruments in the capital market. Shares. Other shares, equity shares. Right? When we say the shares, all these things are included, but we have to say common stock or the equity share. Ordinary shares, these are with the variable dividend. Because for you, you know that for common stocks, ordinary shares, no fixed dividend. There is no fixed dividend. So that is coming under the capital market instruments. Again, you can categorize financial market based on the distribution of the financial instrument as whole money market and the future market. Whole money market way, if the transaction is occurred at, say, at present, now suppose that you are going to the bank, you want some foreign currency, dollars. So you may purchase these dollars from the bank just at the spot. So that is a whole money market. If you are trading some shares today at current market price, so that is the whole money market. So then future market means, suppose that you are entering into a future contract, forward contract to trade certain securities in some future day, in future. So that is we call future market. So you can buy dollars, you can have a forward contracts with the bank to borrow certain amount of dollars in the 1 month. You can agree the price today. So that is coming under the forward or the future market. Whole money market means it is the marketplace where transaction occurred on the spot. And also you can categorize as the organization of the market, whether it is the auction market or OTC market. Auction market or over-the-counter market. Now, if you take our capital market, Colombo Stock Exchange, it is an auction market. There is a physical place. Buyers and sellers can meet even now we are using online platform, but anyway there is a physical place. So that is typically you can identify certain place for this particular market. So that is we call auction market. So the opposite of that is the OTC. Over the counter market. So in the over the counter market, there is no any physical space, any fixed place for this particular market, but this market is around all over the world. That is, buyers and sellers are connecting with the telecommunication equipment or the technology, so they are doing trading. World largest OTC market is the Nasdaq. Nasdaq, anybody here? Nasdaq, that is based on America. And Nasdaq is the world largest OTC market. Dealers, traders are around the world, so they are connected with the technology. So there is not a physical place that is connected with the technology. So there is a kind of market like OTC and the auction type market. So these are the different classification of the market. Out of these 5, first 2 is very important. That is based on the term to maturity and the generation of the financial instrument. So you should be able to define what is money market, capital market, and also what is primary market and secondary market. Debt and equity market also important. Right. So you should read. Under the money market in Sri Lanka, you can see these are the participants: banks, central bank, finance companies, money brokering companies, brokers, businesses, individuals. So these are the participants. And also subcategories. Main subcategories of money market in Sri Lanka include interbank call money market, treasury bill market, commercial paper market, interbank foreign exchange market. This money market, very important to maintain the short-term liquidity in the market economy. Short-term liquidity determined, short-term liquidity is highly influenced by this money market activities. So therefore, that is because you know that money market is the place or the market where short-term financial instruments are traded. So therefore, liquidity, short-term liquidity of the economy or the market will influence by the activities or the happenings in this market. Right? So if you go to the, I think now you can see the web page. Right. Okay. If you go to this cbsl.lk. You can see it is explaining this banking sector, primary dealers, microfinance sector, money brokering industries, everything is there. These are the current and updated information related to these areas. And also, if you go to here, you can see interbank call money market. So that is explaining. You can read it in single also. So what is the interbank call money market? So very simple format. Interbank call money market is the overnight market that mainly assists commercial banks in meeting their immediate liquidity requirement by facilitating lending and borrowing among banks. So you know that banks at the end of the day, they are balancing their cash receipts and the deposits and withdrawals. So when they are balancing, some banks may face shortages, some may have some excess. So then when a particular bank has extra money or the excess amount of money, so they are putting the message in the system, they have some extra money, they can lend. They will put the interbank called money interest rate that is determined with the central bank. So then they will put in the system, we have extra money, we can lend them. So then certain banks are there with the shortages. So they are borrowing at that rate from the, say, BOC is borrowing from the Sampath Bank for overnight, very short. So that is for managing the liquidity position of the each bank. So then this market we call interbank call money market. Very short, overnight. In the next day, they are settling this amount. But the problem is, say, suppose in a particular day, there is no any bank with the excess money. All are with the shortages. So then what they have to do? All are with the shortages. Any bank, any commercial banks, no excess money to lend. So then all are having shortage. So they all need to balance their deposits and withdrawal. They all need to borrow. So then what is happening? So it shows what? Short-term liquidity problem in the market. So then what they have to do? What is the last resort? So then they will access to the central bank. They have certain reserves. So from that they are borrowing and they will balance their day-to-day operation. But anyway, that is problematic. So when they borrow from the central bank, it means that our money market, some issue is there. There is a liquidity issue in the market. So that is affecting to the economy. So that is affecting the liquidity position of the individuals, business and the firms and all the things are affected. So kind of thing. So you should read them. It is explaining how this interbank call money market actions is happening, how the interbank call money market interest rate is determined. So why this call money market interest rate is important for us? We are the depositors. Is it affected to our interest rate? Yes, it is affecting. So that borrowing or lending rate is affecting ultimately our deposit and lending rate. Right? So you know that when you are going to put a deposit, some mostly private banks paying find some more points high interest than the what you call the NSB or the BOC people's banks like the government bank. That is based on their liquidity. If you compare the Sampath Bank and the NSB to make a fixed deposit, you will get some say 0.5, 1 point or so likewise high interest compared to the NSB. There is a difference for the same period deposit. So that is based on their liquidity position. So then and also you can read, I think some might have their working in the banks. This is, I think they know happening things, what happening with the practically actually. So that is the interbank call money market. So that is a main category. Is a main category in the our money market transaction. And also the other thing is you can see treasury bill market. Treasury bill market. So you know that what are the treasury bills? Treasury bill issued by who? Treasury bill issued by who? Oh, government. So government issuing on behalf, central bank is issuing on behalf of the government. So treasury bill is a short term one. So maturity will have a 3 months, 6 months, 9 months, 12 months, or likewise. So when a government needs some short term money, so they are issuing treasury bills. Even you can invest if you have a 1 billion amount. So you can invest in the treasury bill. So you will get a some fixed interest on the treasury bill. So you can invest at the discounted price. So normally treasury bill has face value. Say if it is rupees 100 at the auction, primary dealer is purchasing this at a discounted price, say 80 rupees. So if it is a 3 months treasury bill at the maturity, you are getting 100. So that difference is your interest income. So normally you are investing at the discounted price. At the maturity, you are getting the face value. So you will get a fixed rate of return. So this treasury bill market also subcategory under the money market that is affecting to the financial market or the short-term liquidity of the economy. And also the commercial paper market. Commercial paper in nature it's same like the treasury bills, but it is issued by whom? Commercial paper? Banks or issued by commercial paper. Yes, listed banks might issue in, but normally they are issuing by companies. Commercial papers are issuing by companies, listed companies, reputed company. Mostly they are issuing commercial paper for their short-term funds requirement. They have a certain short-term requirement, so they can issue the commercial paper maybe with the maturity 3 months, 6 months, 9 months, 12 months. So that is their short-term requirement. Right? So normally this is issued by the blue chips companies with the high reputation. So I think you can't say the banks, right? Banks are not issuing, but when a company is issuing a commercial paper, that process is connecting with the bank. So they have to issue this commercial paper connecting with the bank. Even the listed banks might issue. That is short term. That is short term, like treasury bills, you can invest. At the maturity, you are getting the face value. Interbank foreign exchange market, like the interbank call money market. In the call money market, rupees is changing. In the interbank foreign exchange market, foreign currency is trading between the banks. So like the rupees, in the foreign currency also, at the end of the day, bank is balance sheet withdrawals as well as the deposits. So then there is a interbank foreign currency, foreign exchange market also, like the interbank call money market. So that is also explaining in this website. So you should read. So these are the sub market or the subcategories coming under the money market. So then capital market. Capital market consists with mainly you can see in Sri Lankan context, capital market represent with the Colombo Stock Exchange or our capital market, and also the treasury bonds market and long-term interest-bearing assets. That is the what you call the corporate bond market. Right? Three categories are there under the capital market: corporate bond market, treasury bond market, and equity market. Equity market. So these are the structure of our capital market. So capital market is the place or the market where long-term financial instruments are traded. So therefore, capital market consists with the bond market, corporate bond market, treasury bond market, and the equity market. So you know that long-term interest-bearing assets, these are the bonds, debentures, issuing by companies, listed companies mainly. Debentures, bonds are normally issued by listed companies. So long term, maturity is more than 1 year. Interest bearing, you will get, if you invested in the bonds or debenture of a company, you will get fixed interest. We call it as a coupon. In future, you are going to do a bond valuation. There is a separate topic. So that is bond market. So that's the long term instruments. So that is traded. So that is affecting the long-term capital development, long-term development of the economy. So that is affecting to the market, basically not the liquidity, but it's affect to the long-term fund appreciation and value creation in the economy. And also the capital market, you know what is happening in the capital market. Ordinary shares are trading. Ordinary shares, equity shares are trading between the traders. So that is also value created place. It is the place where value created to whom? Shareholders. If I ask a question, is there any connection with the equity market, primary market and the secondary market? Now, secondary market means that is after the primary issue, it is trading between the shareholders. Primary market is the place where the stock is issuing for the first time by the company. My question is whether this secondary market activities or secondary market performance, secondary market happenings, is it influencing to the primary market? Is there any connection between the primary market and the secondary market? Reference to the ordinary shares. Are they independent? Huh? Are they connected or are they independent? There is a secondary market. Now suppose Sampath Bank PLC. For the Sampath Bank PLC, there is a secondary market. In the secondary market, stocks are trading between investors. So my question is whether the secondary market transaction is impacted to the primary market. Huh? Yes or no? Are they connected or are they independent? Link cannot clear on the here. There is a connection. Secondary market transaction, secondary market buying and selling pressure, secondary market in the secondary market value creation or the price appreciation is influencing affecting to the primary transaction, primary issue. Suppose that now in the secondary market, Sampath Bank PLC is trading in the large price. Current market price is very high. Demand pressure is high. So investors are very attracted to the company, so there is a demand pressure. So when the company is looking at it that happening in the secondary market, so what they do, if they want some extra money, they want to transfer their investment, so they can do a new issue. Because there is an interested, attractive investors in the market, if they go to the new issue, seasonal expiry, so then that their stocks will traded in the without any problem because of that secondary market pressure. So that is affecting. So they are interconnected. Secondary market transaction affecting the primary market transaction. My next question. Does the company performance, company happenings affecting to the secondary market transaction? Obviously, introduction company investment decision or whatever the things happening in the company, is it impacting to the secondary market transaction? Exactly. Even though company is not receiving any cash flow in the secondary market, but investors are trading. So that is purely depends on the company happenings. So if the company is doing value created investment in the secondary market, price is increased. If company is doing value destroying investment in the secondary market, price is decreased. So that is these are connecting, right? And the debt market, corporate debt, that is basically debenture and bonds. You know that debentures, bonds are the debt instruments issued by the companies for the long-term debt capital requirement. More than 1 year. So that is long-term. So if you invested in the bonds until its maturity, you will get coupon. At the maturity, you will get face value. So that is also sub-market coming under the capital market. Treasury bonds, like the corporate bonds, only difference is Issued by whom? Corporate bond and the treasury bond. What is the difference? Corporate bond and the treasury bond. What is the difference? Both are long term. Both are long term. Both are with the fixed income because you are getting fixed interest. What is the difference? Corporate bond issued by listed companies, but treasury bonds issued by government, central bank on behalf of the government. It is also long term. When the government needs their funds for the long-term investment or the long-term requirements, so they are issuing treasury bonds. Treasury bills, treasury bonds, they come. Right? So you have to read that, you have to notice that difference. Treasury bills is short-term, treasury bonds are long-term. Primary market, secondary market, I think I explained, no need to repeat it again. Right? Primary market is when the new stock issue is there, primary, and after the first issue, stocks or the debentures or whatever securities can trade it between investors. So that is secondary market. So under the government securities, you should know treasury bills and treasury bonds. This is also I explained for the treasury bills or the treasury bonds. Primary market is the place where the auction is occurred with the central bank and the primary dealer. I think it is there. Look at this one. So you can identify central bank and primary dealer. So this is the best primary market because primary dealers go to the auction on behalf of the investors. At the auction, they are purchasing certain instruments. So that is the primary place, primary issue. So after this, primary dealers can sell these shares to the investors, banks, financial institutions. So that is the secondary market. Corporate companies, investors. So this is secondary. That is the primary market. I clear that? Right. Right. So what is this repurchase agreement and repo and reverse repo? What is repo and reverse repo? Repurchase agreement and reverse repurchase agreement. This is also happening in Sri Lanka. This is a short-term or the money market instrument, repo and reverse repo. This is a kind of agreement between the two parties. So you can see that is also explaining in the central bank website. So this is an agreement between two parties where one party sells the securities for another with the agreement buying the same or similar securities back at a fixed price on a fixed future date, kind of agreement. Suppose that primary dealer selling certain shares to the central bank with an agreement, buy back them in a future date at an agreed price at the agreed future date. So kind of agreement. If you go to the developed countries like this, repurchase, reverse repurchase agreement is happening with the even with the ordinary shares, debentures, like with the different securities. But in Sri Lanka, this repo and reverse repo you can see by using treasury bills. Only by using treasury bills. So what is happening here? So you can see here, this is the dealer and the investor. So dealer, say central bank, on behalf of the dealer, central bank also can be there. So here what is happening? Dealer sells securities by cash. Sells securities. Securities mean treasury bills here. So then dealer is selling certain amount of treasury bills and they are borrowing some money from the market, from the investors. With an agreement, buy back these securities in a future date at a fixed agreed price. So the return to the investor is this selling this buying and the selling difference of the securities. So then on that investors are getting some return. Right. So this is, you can see it is explained. The one selling the repo is effectively borrowing. Now here dealer is borrowing. හරියට මේ treasury bills ටික අපේට තියලා ණයක් ගන්නවා kind of thing. So dealer is borrowing from the investor, is a borrowing, and the other part is lending. Since the lend is credited implicit interest in the difference in the prices from initiation to the pre-purchase. So now there is a difference. මෙතන දෙනගාන සහ මෙයා දෙනගාන අතර තියෙන difference එක is the return, is the income return received to the investor. So normally this is happening when there is what you call excess liquidity in the market, right? There is unnecessarily money is there in the market, no investment. So then that is instability. That's affect to the economic stability. So then if kind of a thing is there, so then central bank is doing what? They are initiating repo kind of thing. මොකද කරන්නේ treasury bills ටික දීලා සල්ලි ටික මේ පැත්තට absorb කරගන්න. So then they are controlling that market stability. So for a short period, so they are absorbing that excess money from their side by selling certain treasury bills. And investments නැහැ. සල්ලි තියෙනවා. ඒතර යාලා treasury bills issue කරනවා. So kind of a thing. So that is we call repo. When you look at this agreement from the investor's point of view, from this side, if you look at this agreement from here, from this side, so that is we call reverse repo. That is reverse repo. This is an agreement in which buyer makes with the seller of the securities to sell the securities back at a fixed price on a specific date. Repo is the reverse repo is the opposite of the repo purchase. From the dealer's point of view here, that is we call repurchase agreement. Repo කියලා කියන්නේ repurchase agreement. From the other side එකෙන් ඉඳන් බලපුවාම that is reverse repurchase agreement. Reverse repo. So this is happening for the short period, maybe 3 months, 1 month, sometimes for the 2-3 days even. That is happening with the primary dealers and the central bank to absorb, to control the liquidity. එතකොට initially liquidity එක control කරලා market එක settle වෙනකොට අර ටික release කරනවා. So kind of a thing. So that is also you have to read. This is, I think, under the this repurchase agreement and the repo and the reverse repo coming under the money market. This is a money market instrument. Because this is a short-term liquidity management instruments. So therefore, this is coming under the money market instrument. If you go to the CBSA website, you can see, you can understand this step. I think I'm taking too much time now. So if you go to here, financial system, you can read, where is it? Interbank all money market, government securities market. Under here, I think it's there. Treasury bill, treasury bonds. Anyway, it is there, right? Primary dealers. I think I can't see now, but anyway, this is there, right? For the repo and reverse repurchase is explained here. So you may go with that and you can see it. I can't see now, but them main and right. So you can search here and also you can read here, right? I will get that. Right. So that is related to the repo and reverse repurchase. So these are the financial infrastructure. So without this technology, without this platform, we cannot do any intermediation. So these are the main system, settlement system, technology that we are using to transfer the funds from the surplus units to the deficit unit. Now you are using debit card, you withdraw some money from the PET machine. Real time, your account is debiting. If you deposit real time, there is crediting. So these are happening with this technology. If this infrastructure fail in a particular day, what would happen? Huh? So you will be stuck. You cannot do anything. Online transaction, payments, withdrawals, everything is in the down. Right. Anyway, you have to read this thing. I think in the O-level also you have this check imaging and truncation system. Check bicycle we are learning that way now. But now think about the development and also think about in 10 years time what would happen. May banks say buildings will empty with the AI and everything. Now in the currently in the insurance industries, AI is using very heavily to claim procedure, identify the clients, what you call the estimate the damage. So they are using AI. But in Sri Lanka not, but in the developed countries, they are using artificial intelligence. But in some universities also, they are using AI for the student registration and everything is happening. So kind of a development. So then these markets over appearance will change. So that is your presentation. You will read this thing. So you have to read this platform. Basically, we have two companies, Lanka Secure and the what is the Lanka? Two systems are there. Lanka Secure and the other thing we may read. Right? I'm not going to do that one because time planning my board will start. And also you have to go to the CSC website also. That is also very important one. For your quiz also, when you are preparing for the quizzes, you have to go to this one also, csc.lk. Right? This is also very informative one. So you can read the overview of the capital market under the CSC. I think this is also you can access in the any language, as I remember. Yes, you can access in any language. So you might read. You can look at the market overview. There is a equity market. Debt market is also trading with the in the secondary market. You may look at this platform. There are certain publication and also this is very important for the your knowledge. Investor, some record, some videos are there for the investor awareness. I think making investor education. So you may listen them. They are explaining how to create the value using this capital market by investing on this. So this is also stock brokering companies, new listing, number of listed companies, indices. What is the number of listed companies at present in the CSC? How many listed companies are there? Around 298. How many sectors are represented in our stock market? In our economy, how many sectors are represented in the market? Sector indices, you have to go 20 sectors are there. So that 20 sectors represent our economy. So you go to these indices. What are the indices? All share price index, Standard and Poor's index, sector indices are there. So you have to read. Now I think these are very not like the time you did your A level. There is no Milanka index now. It has finished. So now there is a Standard and Poor to 20 index, and also the total return index is calculated. when the total return total return index is calculated, not only the price changes, dividend changes also considering. The whole share price index is calculated based on only the price changes. Capital gains itarai gannu. Now the whole share price index is calculated based on the total return. So total return mean capital gain, dividend yield, both. Right. So this is up to you reading. But they are very interesting as you are learning the finance here, business finance. So you should read them. And also you better to go to the security exchange commission also. This is the market. What is the difference between Colombo Stock Exchange and Securities and Exchange Commission? CSC and SEC. What is the difference? This is the CSC, Colombo Stock Exchange, and also this is SEC, Securities Exchange and Commission. SEC. This one. Securities and Exchange Commission. What is the difference? SEC and CSC. Colombo Stock Exchange and Securities Exchange Commission. Governing body of the Colombo stock market is the SEC. This is monitoring authority, regulatory authority. All the stock market rules, regulation, listing rules, whatever the thing, customer complaints, investor complaints, everything is you have to push with this SEC. This is the governing body, monitoring body. Security Exchange Commission. The banks what is the monitoring body? Banks only. Insurance company, sorry, commercial bank, financial institutions, finance companies, who is the governing body? Central Bank. Insurance company, there is an insurance board. For the stock market, Colombo Stock Exchange, regulatory authorities, this Securities and Exchange Commission. So to make it very factful, so that is also relevant. Right. So these are other related to the global financial environment. These are very important web links. Financial Times, Bloomberg, Wall Street Journal, Economist. So these are web links are there. So you have to go there and you have to read. So at this point, I am stopping. I'm going to start the time value money. Anyway, just look at your tutorial related to this. For the financial environment also, financial market, there is a tutorial. So you better to answer them. Now you can answer. Briefly explain the difference between capital market and money market. Provide free financial instruments traded on them. What are the opportunities provided by the financial market? You should be able to explain. Financial system. Explain what is financial system, how it contributes to the development of the economy. Financial intermediaries. Who are the financial intermediaries? So differentiate between the following concepts: direct finance and indirect finance. Direct I explained. If cash flow is received directly to the issuing body, that is direct finance. Indirect means if you go with the intermediaries, bank, brokering companies. So likewise, if you go with the third party intermediary, so that is the indirect finance. Private dealers and investment banker. You have to read. Right? So you have to answer them because if I take time, I think there is, and also a small case is there. By reading this one, you have to identify functions of financial market. So that is explaining some functions in this case. So from that, you can identify functions of financial market. Right. So that's all about the market. I'm not going to explain more than that. If you have any questions, any clarification, you can ask. Now, I'm going to next time value of 1. Any questions, any clarification, any suggestion? Because your quiz in the next week will be on this area. Classroom quiz. Introduction and the financial market, financial system, global financial market. Maybe 15 minutes, sorry, 30 minutes. 30 minutes, 15 questions. 15. You have to talk with your CP multiple questions. So you have to use, but I'm shuffling the question, right? So you can't copy. When I upload the question paper, I'm shuffling the answers. So that will, what you see may not the one sit right here. So then you copy the answer. My main problem is this virtual. They will be like nothing to evidence. Because that is open book, right? We can see the notes have activities. That is open book. For example, I don't like this. So, shall we go to the time on your problem? We need a break before starting that because then I can continue. Out, take the break later, right? Any question? Any clarification? This is must, right? So we have to read this. Is it kind of a story? Actually, when you are reading in knowledge and also that is interesting as a habit. Then we go to the central bank website. What is the previous equation? And I think in the last week also I asked you. So what is the current deposit rate, lending rate, treasury bill rate? So you have to go to the central bank website and look at the updates. So this is updated website continuously. So you as a habit go to these websites and read. Right. Now we are going to that time value of money. That is where we are starting financial management. Right. Time value of money. You know that objective of financial management? What is the objective of financial management? Last week we discussed. What is the objective of financial management? Maximizing shareholders' gain. Or simple, creating value. Creating value to the owners. Creating value to the, if it is a personal finance, creating value for the person. So likewise, the objective is creating value. Making wealth. Right? So you know the wealth and the value difference. Sorry, income and the value difference. So now the objective of financial management is creating value for businesses, for the owners of the business, maybe for the individuals, creating value. So in order to create value, so you should know that when some income is receiving or some investment is doing, there is a certain period that you have to wait to get some return. Right? So now today I'm doing an investment with the expectation to have a certain amount of interest future. So that is my expected return. So based on this expected return, I will create value. I will calculate my value. But anyway, that expected return has uncertainty. And also this expected return you are receiving in future. So therefore, the amount receiving in 6 months, say 5,000, and now the 1,000 today, it's not the same. It's not the same. There is the time gap, time difference. Now, if I ask the question like this, suppose that I have a certain amount I have made to pay. So I have some money borrowed, so I have to pay that. So if I ask you which option you may like, suppose that 5,000, having this 5,000 today, or having this 5,000, say I will say next week. These two options, getting the today or next week. But which one you prefer? In having this 5,000 just now or getting it in the next week? What is your prefer? Just now. You want it just now. Even though for sure I am giving you. I'm not recording, I will give you. But anyway, as a human being, you prefer to have it now. Why? What is the reason? You want it now. So what is the reason? What is the reason? Why do you want it now? Oh, sure, I'm giving next week. God wants suspense. So why do you want that money just now? What are the reasons? There is a risk. There is a risk in next week and have a statement. And also there is a now if you have this 5,000 today, you can go to McDonald's or whatever, you can eat some extra things and you can go to the certain, let's say, cinema kind of thing. You can take it as for your enjoyment. And also you can invest. You can deposit it in a savings account and you can get some interest. So likewise, you have certain ordinary. Risk is there, ordinary uses of money is there. You can use it for your consumption, that money. So likewise, certain things are there. So because of that, we prefer to have money investment. So I am telling like you, today, if I am giving this money today, I will give 5,000. For the next week, I will give 5,500. I'm adding some premium for your requirements. Now you have certain reasons now to have this money today, to capitalize them, to quantify them. I will add some extra 500 and I tell you, I will give 5,500 next week. Now which one you will? Which one you will? 5,500, okay. Now which one? Now do they have the 5,000 now or? Next week 5,500. Now which one do you do? How to determine it? Then you have to determine it whether you get 5,000 now or am I waiting till next week to get the 5,500. So you have to take a decision. How to take that? How to take it? Yes? How to take it? How to evaluate the now that we have two options. Having 5,000 to that the previous option is clear. So when they gave 5,000, having 5,000 today or next week also 5,000. So एक तो कहाँ दिन तो हम adjustment कर रहे हैं. Time adjustment कर रहे हैं. 5,000 is next week and the 5,000 is just now because one Lanka anything after the one is clear. So therefore you prefer to have just now. It is clear. Now second option I am asking you today 5,000. If next week 5,500. So now I am asking which one you prefer. Discounting using what? On the inflation. Right. Correct. So now you have to take decision whether you are receiving this 5,000 now or whether you are having it 1 week. Now this is the option. If today, right? If today I will give 5,000. Say 1 week I will give 5,500. So you want to take some decision. So now what you have to do, you have to see whether this 5,000, whether it is equivalent 5,500 in 1 week. Or you have to check whether 5,500 you are receiving in 1 week, whether it is equal to 5,000. So likewise, you have to evaluate. So to evaluate, you should use, as you mentioned, you are using the discount rate. You are using a discount rate. So what is this discount rate? What is this discount rate? This is your required rate of return for your funds, your money. That is your required rate of return. මේවා ඉස්සරහට හම් වෙනවා, right? So in the future we estimate the required rate of return using cost of capital in the security valuation. But anyway, you should understand the concept. So you are discounting using certain percentage. But why inflation is also correct, but not only the inflation. Right? So that is your required rate of return. So using your required rate of return, you discount this expected cash flow and you see whether this expected cash flow is equal to 5,000. If so, you are in a indifferent situation to having this 5,000 today or having this 5,500 in 1 week. They come in time. After discounting this 5,500, ඒක 5,000ට සමානයි නා. ඔයාලට මේ 5,000 හම්බුනත් එකයි, මේ 5,000 තව සතියකින් හම්බුනත් එකයි, because these are equivalent. These are equivalent. Right. So this is what we are going to do. Throughout this time value of money, this is what we are going to do. I will explain one more thing. So this is your required rate of return. So normally in practice, your required rate of return you can identify by looking at the market, by looking at the current ongoing interest rate, market interest rate. So that is reflect current investors' required rate of return in very simple. Right? So this required rate of return is equal risk-free rate plus risk premium. Based on these two, this required rate of return is calculated. Risk-free rate of return plus risk premium. So I will come to this point, I think, with the slide. So this is our overview, right? So today, with this time value of money, different cash flow, single cash flow, multiple cash flow, annuity, perpetual type cash flow, different cash flows we are going to value. Because you should know to calculate value in order to value maximize. අපේ objective එක achieve කරගන්න අපි දැනගෙන ඉන්න ඕන value එක for the different periods වලට කොහොමද calculate කරන්න කියලා. Right. So these are the learning objectives. I think I explained them. You will identify time value of money concept. You will learn compounding and discounting process. You will calculate present value and future value for the different type of cash flow, and also some application. These are useful for your personal life. Right. So as I asked, what would you prefer? Yes, having money today. That is you prefer because of that reason. So what are the reasons for that? High value of money is a financial concept that refers to the idea that the value of money changes over time. Value of money changes over time. So that is creating some value. So therefore, there is a difference. Different money or the cash flow receiving in the different time periods are having different values. So it is essential to recognize that certain amount of money today is worth more than some amount of money in the future. So you should be able to calculate value for a different time period in order to take investment decision, financing decision. So you should be able to do that one. Right. So what are the reasons? Reasons for the time preferences of money. So you told that, yes, having today is preferred. Because of this reason, individual preference for the early consumption. As I told you, if you have this 5,000 today, you can go to McDonald's and you can have a fried rice or whatever. So you are having some chocolate, ice cream. So there are certain alternatives. Early consumption is better than waiting in until you are becoming matured or kind of thing. Now, say today you are in a good health situation. You haven't blood sugar, pressure, cholesterol, so you are free from all. But in 5 years' time, maybe 1 year's time, you will be a patient with some cholesterol, sugar, so you can't eat something. So that early consumption is preferred. මිනිස්සු එක වෙනම theory එකක්, people are prepared to have things early. ඒකට අපි කියනවා කෑදරකම නෙමෙයි. So that is the nature. We prefer to have early. Early consumption is preferred because in the elderly, when we reach to the elderly age, some parts, sweets kind of thing we can't eat because of the health. And also that is one reason we call it as a what is consumption based requirement, preferences for the early consumption. That is a separate theory coming from the social sciences. And also there is a alternative uses of money. ඕනතරම් දේවල් තියෙනවා සල්ලි තියෙනවා නම් කරන්න. සල්ලි තියෙනවා නම් ඕනතරම් යාළුවෝ ඉන්න බලන්න යන්න. There are certain alternatives. Trips යන්න පුළුවන්, චිත්‍රපටි බලන්න යන්න පුළුවන්, ඇඳුම් ගන්න යන්න පුළුවන්, යාළුවෝ බලන්න යන්න පුළුවන්, dinner out යන්න පුළුවන්, lunch out යන්න පුළුවන්, whatever. So there are certain alternatives as well as you can invest. As an investor, you can invest if you have money today. So by investing, you are getting return. And also the risk. When you are waiting future, some period to get certain amount of money, there is a risk. There is a risk. So therefore, as an investor, if you are delaying to receive certain money, so you should have some compensation. You should have some premium for bearing the risk. So bearing, sacrificing this ordinary uses of money. And also, as I mentioned, there is inflation. With the inflation, real value of the money is decreasing. So today you may have certain foods for the 5,000, but in the next week you can't eat it with the inflation. Real value is decreasing. So because of this reason, you have time value of money. You have time preference for money. So therefore, if you are waiting till next week or next month to get this 5,000, you have some extra premium for bearing this, for bearing risk, bearing inflation, alternative uses of money. So for this reason, you have to have certain compensation. So you will wait. You will okay to have 5,500 in next week. So then you can see your required rate of return is including this. You can see your required rate of return is equal risk-free rate of return plus risk premium. So here you can see two components are there in this risk required rate of return. Compensation for current foregone consumption and also expected rate of inflation. So this risk-free rate of return includes this is actually the base formula for the required rate of return. Required rate of return is equal risk-free rate of return plus risk premium. So this risk-free rate of return includes two components: real rate of return and expected inflation. Expected inflation. And this is risk premium for the risk, for the uncertainty. Right? So you have to have some extra money based on your required rate of return. So your required rate of return includes some compensation for ongoing consumption. So that is the risk real rate of return. Consumption premium back, and also there should be a certain compensation for the expected inflation. Risk-free rate of return. Risk-free. That is risk-free rate of return. Practically, risk-free rate of return you can extract. The proxy for the risk-free rate of return is treasury bill rate of return. Treasury bill. Risk-free rate of return you are getting from the treasury bill. Or you can take, if it is long-term, treasury bonds also, because that is risk-free. I am even risk-free. It is issuing by government. Treasury bills, treasury bonds are issuing by government. So that government securities are default risk is free. There is no default risk. Right? So the rate of return included in the government securities are for ongoing consumption and the inflation. So that reflects the time value of money. Then you have to add certain premium for this risk. Because compensation for the uncertainty of the future cash flow. So there is uncertainty. There is a risk. So you should have a certain compensation for the risk. So that is the expected risk premium. Either base your required rate of return. Your required rate of return conceptually is equal risk-free rate of return. So this is the time value of money. In addition to that, we are adding certain risk premium for the uncertainty. Either required rate of return other your present required rate of return is say 10%. This is your required rate of return 10%. Annually today 5,000. Either 1 year 5,000 well at 10%. Today, if you are receiving 5,000 is okay. If your required rate of return based on the current market interest rate, if it is 10%, in 1 year, you would have 5,500. So that is adjusted for the time value. That is adjusted for the risk. So that is what we are going to do. Okay, so this is overview of the main. I need a break, but not a. You know? 10, you need a break? And a break, yeah. You are understand. So then we can continue with the calculation. Come, break is 20 minutes. Come back to break. EI, expected inflation. Expected inflation. This is real rate of return, real without inflation. We can move the unpathetical real rate of return. So this is the expected inflation. Either risk-free rate of return. Risk-free rate of return includes real rate of return and the risk-free rate of return. Extra risk premium adjust risk and return premium calculate. So you will touch with the same thing in future again and again. So this risk premium quantitatively you can calculate. So gradually your required rate of return you can determine. Right, we'll have a break and come in 20 minutes. Shall we start? So, so you can see the what I earlier repurchase and repo agreement. I think it is there in the financial system. You can see financial instruments overview is there. So under it you can see it's explaining the available financial instruments in Sri Lankan context. It has revised more, right? At that time there was more than this explanation. But anyway, now I think it has updated. So the next step. Repurchase agreement is explained like this as I explained. So you can read commercial paper, corporate bond, debentures, financially asset-backed securities. So all are there. So that's what I wanted to show you. Now in the time value. Okay. Now with the initial understanding of the time value of money, so it is agreed. Now it is agreed. Therefore, rupee received today more valuable than rupee received tomorrow. Rupee receiving today more valuable than rupee receiving tomorrow because of the time value of money. But today value and the tomorrow value, if you adjusted for the time difference and the risk differences, they are equivalent. They are indifference in the time adjustment, after the time adjustment. Therefore, cash flows receiving in the different time periods, you cannot compare them as it is. Right? You cannot compare them as it is. The money receiving, cash flow receiving in the different time periods, you cannot compare them as it is. So you have to adjust them for time differences. So that is what we are going to do here. So when you adjust in the time value, two processes are there, that is we call compounding and discounting. Throughout this lessons, we are going to compound the cash flows to get the future value. We are discounting cash flows to get the present value. Two processes are there, compounding and discounting. So you can see what is compounding. So compounding means converting the 20,000 rupees today into its equivalent value in the future. In the timeline, we are going in forward. Today, 20,000, you want to see what is its equivalent value in 1 year, in 3 years. So likewise, if you are going forward in the timeline, we call that process is compounding. Process is compounding. So then what is the discounting? The opposite of the compounding. Transfer 20,000 you are receiving in the future, it's today equivalent value. Suppose that you are getting some money in say 5 years from now. So what is its present value? Today equivalent value. So that process we call discounting. So these two processes you are going to apply time to time to calculate the present value and future value. So through this discussion. So now you should know to define timeline. Before going to the calculations and the things, you should know to define the timeline. So this is the structure or the format of the timeline. So you can see in the timeline, time is denoted using the letter T. Normally in default, we are using the letter T. So you can see T equals 0 mean today. T equals 0 is today. T equals 3 years from today. T equals n years from today. Right? So you can define like this. T equals 0 is the today. T equals 3 years from today. So likewise. So gap between the 2 years. It can be yearly, monthly, daily, weekly, whatever. Time differences. Right? So that difference between the two years. Here say that is years. So this is the 1 year. That gap. You can say this is a 1 year if it is yearly, or if it is weekly, 1 week, can be daily even, right? So then beginning point and the ending point you should be able to define. So now if you look at this gap here, from here to here, so this is the end of the year 1. This is the beginning of the year 3. So if you go to the first range, this is the beginning of year 1. This is the end of year 1. If you go to this range here, this is the beginning of year 4. This is the end of year 4. So likewise, the gap or the range in the time you are defining like this: beginning point and the ending point. I clear it? So here, this gap indicate a year. So here the beginning point, this is the ending point. So likewise, you should define when you are doing the applications calculation, you have to draw the timeline. So likewise, beginning and the ending point you can define. The other one is, these are the assumption in the timeline. So I explained, I think, all the things. A point in time denoted with the letter T. Unless otherwise stated, T equals 0 represent today. Decision point. Normally, cash flows occur at the end of the time period. So that is important. In default, cash flows are occurred at the end of the time period. Right? So now here you can see, now this is based on the years, right? So this is a 1 year. So normally in default, cash flows occurred end of the time period. Say likewise, this is T equals 0, T equal 1, T equal 2. So likewise, so normally suppose that first cash flow, suppose this is 1,000 you are receiving yearly. At the end of every year, you are getting 1,000. So at default, normally cash flows occur end of the time period, end of the year 2, end of the year 3, so likewise. Right? It is default. Cash flows occurred end of the time period. Suppose now, for the example, today you deposit some money in a savings account. So your first interest you are receiving end of the month, end of the period. There are beginning period cash flows also, right? In the annuities, we are discussed the due annuity. But anyway, normal default case is cash flows occurred end of the time period. End of year 2, end of year 2, end of year 3, so likewise, not the beginning. So that is in default. And the other thing can be inflow as well as cash can be outflow. There can be an investment and also return. If it is an inflow, we identify it as a positive cash flow. If it is outflow, that is we identify as a negative cash flow. Last one, compounding frequency is the same as the cash flow frequency. I think you may not understand this assumption at the moment, but anyway, in future, when we compound in cash flows with the more frequent compounding, you will understand this. But anyway, this one, it says normally compounding frequency should be equal to the cash flow frequency. Suppose that you are doing the investment. You are investing 5,000 at the end of each month, say for 5 years. Right? So you are investing 5,000 at the end of each month for 5 years. Okay. So for per year, cash flow frequency is how much? Per year, cash flow frequency is 12 times. At the end of each month, you deposit 5,000. So 12 times per year, you are depositing 5,000. So if you are calculating future value, so you have to consider 12 as the compounding frequency per year. If it is 5 years, your compounding frequency is 60. 12 into 5. So that is the meaning. So normally in the assumption, compounding frequency should equal cash flow frequency. If you are depositing cash flow monthly, your compounding frequency also should be monthly. If you are depositing quarterly, compounding frequency also should be quarterly. So that should, in the same way, cash flow frequency kai compounding frequency kai samana window. Right. So these are the assumptions in the timeline. Any clarification? Anything if you are not clear before going to the calculation? Okay. Right. So now let's go to the type of cash flow. So we are using single cash flow, multiple uneven cash flow, annuity. So now here we are going to calculate value for different type of cash flow. Single cash flow. Single cash flow means, suppose there is a cash flow stream, you have only one cash flow, say like this, 0, 1, 2, 3. 3 years from today, you are getting 1,000. So this is the your investment or whatever your stream of this cash flow. So there is a single cash flow. So you can calculate present value, you can calculate for the another future. So likewise, you can go here and there in the timeline. There is only one single cash flow. We are going to calculate present value, future value for a single cash flow. It can be here also. Say at the end of the year, your deposit 1,000. So you want to calculate future value. So like this. Right. Multiple cash flow mean you have more than one. If it is a timeline, say your deposit at the end of each month, 1,000, 1,500, 2,000. So likewise, multiple. There is a different cash flows, but they are not even. Multiple uneven. So that is what we call multiple uneven. So end of year, end of first month, you deposit 1,000. 2 months from today, you deposit 1,500. Say 3 months today, you deposit 2,000. So likewise, different uneven cash flow. So we are going to value this type of investment, this type of cash flows. And also it can be annuity. If it is annuity, that is even. Say end of the year 1, 1,000. End of year 2, 1,000. End of year 3, 1,000. End of year 4, 1,000. So you can see cash flows are identical. They are even. So this is we call annuity. This is multiple uneven. This is single cash. So we are going to discuss these three types of cash flow in calculative value. Can I have example for the multiple uneven cash flow in the practical world? Example for the multiple uneven cash flow? Yes. It should be occurred in the same time period, but it is uneven, multiple uneven. So many examples are there. Your telephone bill, electricity bill, they are not fixed charges. For the annuity type of cash flow. Huh? Insurance, if it is not changing, it is annuity. Suppose the if you are borrowing loan, if you have a loan from a bank, so your monthly installment. At the end of the each month, you deposit the same amount with the bank. So that is an annuity at the same amount. Certain examples are there. So future we can look at them again. So let's start with the single cash. Right. I will give a certain calculation. Suppose that suppose you have deposit. Suppose you have deposit 1,000 rupee. You have deposit 1,000 rupee in a savings account. You have deposit 1,000 rupees in a savings account, which pays interest 10% per annum. Now deposit 1,000 in a savings account, which pays interest on 10% per annum. What is the balance of your account in 5 years' time? What is the balance of your account in 5 years? Quickly calculate what is your account balance in 5 years. You deposit 1,000 today in the account, which pays 10% interest per annum. So how much you will have in 5 years? How much will you have in your 5 years? What is the balance in your account in 5 years? I can see different answers of it. So in 5 years, you will get 1,500 then. Yes, that is, you can understand. So now, if you look at here, you can see, so some of you have calculated by like this. 1,000 you are deposit today for 5 years at 10% interest per annum. So you have calculated it like this. If it is 1,000 per year, you are getting you will get 10 rupees as interest. Okay, 1,000 into 10%, 10%. You will get 100. So then 5 years you will get this into 5. This into 5. 500. So then you may get the into 5. You will get 500. Right, anyway, you will get 500. So then total is end of 5 years, you will get 1,500. Is it the way you are getting interest in your banks? I noticed that some of you are having that value, 1,500. No. This is simple interest calculating, right? This is simple interest calculation. This is not the reinvestment assumption is not there. But anyway, this is calculating based on your compounding value. There is a compounding process throughout this interest on interest is accumulated. Now, if you calculate here, this is today you are deposit 1,000. So at the end of year, at the end of this first year, you are getting how much? On this 1,000, you will get 10% as the interest. So you will get 100. So end of the year 1, your account balance is then initial deposit is 1,000 and the interest amount for the year 1 is 100. So that is 1,100. So the opening balance or the beginning balance in the year 1 is now not the 1,000. So because of the first year interest, now it is 1,100. So then this is the balance for the year 2. So now you are getting interest not on the 1,000, but on the 1,100. So then year 2, you will get the interest as how much? 110. So likewise, you can see now the year 3, beginning of the year 3, your account balance is how much now? 1,000 plus 110 is the interest. It is 1,210. So then you will get interest based on this value. So then how much the interest? 121. So then year 4, the amount is now opening and the interest on interest is there. So you have to add that. So now there is 1,000, amount is 1,331. So year 4, you are getting interest on this value. not the 1000, 10% on this. So that is this 133.10 rupees. So here 5 opening balance is now, you can see like this. So how much your balance in your account at the end of year 5? It is 1,600. So now you can see this is not the simple interest. In this process, you are getting interest on interest. We call this process compounding. This process we call compounding. And also the theoretical things under this compounding is reinvestment. Reinvestment assumption. So the interest you received in the year 100 rupees, you have reinvested throughout this investment period for 4 years. So you are getting on that interest, again you are getting interest. So that is actually the theoretical concept is reinvestment process. So that is we are calculating that process we call compounding. So therefore, if you calculate this by using the simple interest, that is wrong. In financial management, reinvestment assumption is very important. Now, this is 5 years. So without problem, one by one, you calculated at the 5 years at the end of the balance, you calculated manually without any problem. 5 years can manage. But if I ask you, what is the balance of your account in 30 years? So that is difficult. So therefore, there is a formula to calculate future value of single cash flow for any n period. Future value, single cash flow for any period. For any n period is equal present value into 1 plus r into the power n. So you can calculate future value for any period by applying this formula. So this is we call single cash flow future value calculating formula. So now if you apply this example here, present value means your current investment. You deposit today 1,000. Your interest rate of return, discount factor, your recurrent rate of return. In future, we define the same thing as the cost of capital in the company or the security valuation. So this is 10%. This is your opportunity cost of fund. This is your recurrent rate of return on this investment. This 10% include premium for the time value as well as for the premium for the risk. So after adjusting your risk and as well as time value, your recurrent rate of return is 10%. So it is you can take from by looking at the market interest rate. Current prevailing market interest rate is the current investors' required rate of return in our market. So then it is 10%, time period 5 years. So you will get 1,610. So then you can apply. If I ask you to calculate what is the balance in 30 years, very simple. What is the balance in 50 years? So likewise, you can calculate under the assumption. Under the assumption, interest rate is constant. We are assuming here that interest rate is not changing. It is remained as 10%. Right. So now this is the first formula in the time value of money. So now if you look at the definition for the future value, you can see that is the total of the principal amount and the interest accumulated on the principal. Future value is equal what? Principal or the current deposit and the present deposit and its interest accumulated on the interest. So that is what we calculated. Another definition is there is the sum, which is initial amount or the principal amount or the present value is expected to grow over given period of time. So this is actually the second definition is this formula. This formula has derived from the second definition. So what is the future value? It is the sum which an initial amount or this present value expected to grow in certain period. So our growth rate here, that is interest rate, 10%. So these are the definition of the future value. So you can see this formula. So this is the formula for single cash flow future value calculation. In this formula, 1 plus r into the power n, this part. 1 plus r into the power n. 1 plus r into the power n. This part in this formula, we call or we term as future value interest factor. Future value interest factor for a given R rate or N period. Future value interest factor. This one, right? 1 plus R into the power N. Future value interest factor. So if you know financial institutions, banks, they are using time value table. They have their on their desk time value table. So they are not applying formula. Simply they go to the time value table and they identify relevant time value factor and they do the application. So there are in financial management textbooks, you can see there are 4 time value tables. 4 tables. One is future value interest factor table. This one. Second one is future value interest factor annuity table. Third one, present value interest factor table. Fourth one is present value interest factor annuity table. So table 1 is future value interest factor table. So you can get the same value by looking at this table. So this is a kind of table. I have a screenshot is there. So you can see there are number of rates are there in the row wise and the column wise, and also in the row you can see end period. So this is for 25 years. 1% to 20% is input. Now, if you want to calculate now, and also table 1, you can see future value interest factor for single cash flow. Right? Future value interest factor for single cash flow. Annuity single cash flow. So now what is in our example, what is the future value interest factor? So you have to go here, the column is 10%. Here, the applicable column is 10% or 9%. So that is 10%. So and the period is 5 years. So what is the factor? You can identify here 10%, 5. Factor is 1.7716. So then you can apply here 1.776 is the future value interest factor. How is it? 10%, 5. 1.61. 1.610 is the future value interest factor. So simply you can multiply it by the current investment. So you will get the answer. So normally banks, finance institution, they are using this table. Same table factor you can calculate using this formula. This is the formula. For the exam, we are not provided table. So therefore, you have to apply formula to identify the factor. So this is the future value interest factor table. Now you can see there is extraction from the future value interest factor table. Now if I ask a question from here, say if you deposit 1 rupee today at 10% interest rate, how much will you have in your account in 9 years' time? If you deposit 1 rupee in a savings account which pays 10% interest per annum, how much will you have in your account in 9 years? Huh? 2.35, 2 rupees and 35 cents. So this factor has calculated for 1 rupee. So then you have to multiply it by your cash investment. Right. So you can see over the time what is happening to the future value interest factor. So this column is the future value interest factor. Right? Future value interest factor means 1 plus R into the power n. So over the time, what is happening to the future value interest factor? It is increasing. It is increasing because of the compounding impact. Compounding impact. So you can see here interest on interest is calculating. This is accumulating process. So therefore, over the time you can see future value interest factor is increasing. So as a result of that, if you calculate the present value of expected cash flow, it is decreasing. When the time is go increasing, your present value of the investment, when you are discounting using the present value interest factor, it is decreasing. So you will see that one in the later. Anyway, this is compounding, this is increasing. So therefore, you can see a relationship like this between interest rate, time, and future value interest factor. So you can see the relationship like this. Now, if you take here, say 10%, sorry, here 10. So this is the period in the X. In the y-axis, you can see future value interest factor. Now, if you take here, this is 10 years from 0. So now these are for the different rates. Green one for the 0%, red one for the 5%, and yellow one is 10, and the purple one is the 15%. So if you calculate, you can see what is happening here. So these are the future value interest factors for the different interest rate. So if it is 0%, no growth. No growth. 1 rupee remains as 1 rupee throughout the year. There is no growth. At 5%, so this is the growth of your investment. Because future value interest factor increasing at here 5%. If it is 10%, so you can see it's more than the 5%. If it is 15%, so you can see the how it is moving. So there is a positive relationship between number of years, interest rate, and the future value interest factor. It is correct, no? Now, future value interest factor here, future value interest factor is equal 1 plus R into the power n. When the n is increasing, this is increasing. Okay, 1 plus R into the power n. When the n is increasing, number of years is increasing, factor is increasing. When the R is increasing, factor is increasing. So there is a positive relationship between interest rate, future value interest factor, number of period, future value interest factor. Right. Now, right, before going to the calculation, I think this one also. Right. Now, normally, you know that banks, financial institution, normally they present interest rate as an annual rate. Now, if you go to the bank and if you ask from the manager what is the interest rate today, he's telling, say around here, the savings interest rate here. How much the interest rate on the normal savings? 3%, 2%, 4%, around 3% is there, 3%. Right. So he's telling like this 3%. So this 3% normally it is per annum. Financial institution, banks, central banks, they declare interest rate as an annual rate. They are not telling per month mechurai, per day mechurai, per quarter mechurai. So not like this. So normally interest rate are presented as rate of return per annum, 3% per annum. In your question paper also, normally interest rates are writing or interest rate are presented as a 12% per annum, 3% per annum. So likewise. But in practice, you know that Now, if you go to the People's Bank, I think you all have a People's Bank savings account. So interest is calculated. Is it annually, monthly, quarterly, or whatever? For the how about the experience? Are they calculating interest one time per year? What is the frequency of interest calculation? Normally monthly, no? Savings account, normally I think all the banks, they are calculating interest monthly. So this 3% interest per annum compounding monthly, right? So per year, bank is calculating interest for 12 times. That is what is happening in the practice. So there is a more frequent compounding. But interest rate per annum is say 12% per annum. So your monthly interest rate is how much? 1%. If the 12% is the annual interest rate, you are getting 1% monthly. So when there is a more frequent compounding, you should learn these two concepts. Nominal or the normal annual percentage rate and annual percentage yield. Two different meaning. When there is a more frequent compounding, annual interest rate is different from annual percentage yield. We call this as effective rate, or we call effective yield. There is a difference. Do you agree with me? When the interest is compounding monthly, even though bank says your annual interest rate is 12%, actually, really, if you are getting more than 12%. You agree? Yes. Because of what? Because of what? When the bank is compounding interest monthly, suppose that annual interest rate is 12%, right? Annual interest rate is 12%. Bank is compounding interest monthly. Okay, count එක මාසික පොලිය දානවා. Compounding monthly. එතකොට monthly වලට හම් වෙනවා 1%. එතකොට for the January, for the first month, you are getting 1% interest on your account. So this 1% interest is considering when you are calculating the interest in the second year, or say next month, February. And also this January interest in your account is compounding for 11 times. But bank says your annual interest rate is 12%, but truly, actually, you will have more than 12%. You will get more than 12%. So that is we call effective rate. Or we call annual percentage yield. Yield කියලා කියන්නේ ඇත්තටම ඔයා realize කරගත්ත rate එක. The bank says the annual interest rate is 12% per annum. Your actual realized yield is more than 12%. So now we are going to identify this one. I think you might have seen when banks, when they advertise fixed deposit in papers, have you noticed that annual interest rate is 14%, annual effective rate is this much. Have you noticed that? So that is the meaning. Because of the compounding impact, you are getting more than the real annual rate. How about the opposite of that? This is for the deposit, you are getting more. If it is a loan, when it is loan interest is compounding monthly, you are paying more than 12%. Bank loan interest is 12%, but actually at the end of the period, you have paid more than that because of this compounding effect. Right? So let's see how to calculate this one. Now, you can see there is a deposit. You are depositing 300,000 in an account, right? So the present value of your investment is 300,000 in account, which pays annually 12% per annum. So interest rate 12% per annum. So if interest is calculated or interest is compounding annually, how much would you have at the end of the period? If interest compound by annually by the bank, what is your balance at the end of the year? You have deposit 300,000 at 12% per annum. So how much the balance if interest compounding frequency is annual? So you will get your future value. We apply the formula equal present value into 1 plus r into the power n. So you will get present value is 300,000. Annual interest rate is 12%. So 1.12. N here 1. So n is equal 1. So you will get next 330,000. 36. 330. This one. Suppose that bank is compounding interest semi-annual. Interest is compounding now semi-annual. Semi-annually mean how many times you are getting interest per year? 2 times. Semi-annual means 6 monthly. Then 6 monthly semi-annual. Right. If the bank is paying semi-annually, now what is the balance of your account? At the end of the year, how much should you have? Now paying interest semi-annually. So therefore, for the first 6 months, you will get 6%. For the next 6 months, you will get 6%. That means 12% you will get it like this. Now you can calculate. I will apply the formula directly because you should. So now this is the formula for calculating the future value. When there is a more frequent compounding per year, so we are adjusting this formula. You can see like this. There is small adjustment we are doing. What we do, we divide annual interest rate by M. We multiply here number of years by M. What is the M here? M is compounding frequency per year. M is compounding frequency per year. So, if interest is compounding semi-annually, how much then? 2 times. 2 times per year. Compounding frequency per year. If it is semi-annual, compounding frequency per year, 2 times. So this is the formula to calculate the future value when compounding frequency is more than 1 times per year. When more frequent compounding is happening. Right. Now, semi-annual compounding. They are paying this one semi-annually. So what you have to do? This is our normal formula. So now you have to divide R by M. You have to multiply N by M. Right? So R you divide by M, N you have to multiply by M. So now calculate the value or the balance of your account at the end of the year. So your deposit is 300,000. Same. R is the annual interest rate, that is 12%. Divide by M. M is the compounding frequency per year, that is 2. Multiply by N. Here in this example, N is equal 1. N is number of years. Then we have now here N is equal 1. Compounding frequency If it is semi-annual, now 2. How much the value? If the interest is compounding semi-annually, what is the value? 300. You will get 337,800. 80. The harder the possible. 80. Right. So now what is happening? Interest rate is not changing. It is 12%. Only the interest compounding frequency has changed. So if interest compounded semi-annually, you are getting more than this 337,080. So now you have an advantage. You are getting some yield because of this more frequent compounding. Even though bank says you are getting 12%, you will have more than 12%. Now let's calculate effective rate implied here. Effective rate implied here. So effective rate you can calculate. This is the formula. Effective yield or the effective rate is equal 1 plus annual interest rate divided by compounding frequency per year into N into M. 1 plus R divided by M into the power N into M. Remember, then from that answer you have to deduct the 1. අපි මේ හොයන්නේ effective interest rate එක or annual yield එක. Right? When you calculate the effective yield or the effective interest rate, remember N here always equal to 1. Effective yield per annum. So therefore N should be always equal to 1. Either සමහර පොතවල මෙතන N නැහැ. N එක නැතුවත් formula එක තියෙනවා. So there is no effect on that on the N. So always N is equal to 1. Minus 1. 1 කියලා කියන්නේ අපි අර effect full investment එක අපි මෙතනින් එකක් අඩු කරලා අපි rate එක ගන්නවා. Right. So now effective rate is equal for this semi-annual compounding. Effective yield is equal 1 plus 12 divided by 2. 1 into 2 minus 1. So as a rate, you can multiply the answer by 100. Make a rate, so therefore it's better to present as a percentage. How much the effective yield? $12.36. Not the 12%. You are getting really truly more than that. That is 12.36. So that is the effective rate. That is the annual percentage yield. Right? So I think the concept is now clear. So you may calculate for the other frequencies. If it is quarterly, if it is monthly, daily, forget about the continuous one. Now if it is for these different compounding frequencies, calculate future value and effective yield. Like this. Do it now. Now we did the semi-annual one. So now you do for the quarterly, monthly, weekly, and daily. If you have any calculations question, you can ask, right? So quickly. quarter, how much debt is equal 4 times. Monthly, 12 times. Weekly, 52 times. Daily, 55. Uganda, Uganda 365 normally classified among Uganda. The age value. Whichever you want, they should be great. So you can check your answers with this. So you can like this future value and then get it. So what is happening when the compounding principles is increasing, effective yield is effective rate is when the compounding frequency is increasing, what has happened to the effective rate? Increase. Because there is a compounding process and also future value also increasing. Compounding value also increasing. So this is good for you. When you are doing the investment, if interest is compounded more than 1 times per year, so you will get some advantage. You will have some advantage because of this effective compounding of the interest on interest. Right. Now the next one is, if there happen continuous are you okay with this? Later you can do it form leisurely. You can check the answer. Say that if you have deposited some money for the continuous compounding, අපි සිංහලෙන් කියන අඛණ්ඩ සංයුක්තකරණය. Continuous compounding, if you deposit some money for the continuous compounding, so interest is compounded continuously. Even for a nanosecond, for a small time period. So interest is continuously compounding. So that is mathematically in a continuous process. For a short time period, even interest is calculated. So this is, I think, happening with the credit cards, as I believe. Now suppose that if your payment due in today, if you pay the credit card bill, say 12 පහු වෙලා විනාඩි 2ක් විතර පහු කරලා ගෙවුවොත් what is happening? They are charging a small interest. So that is continuously they are compounding. So practically there is a certain things happening for this continuous compounding. It is happening like this. So when with the continuous compounding, what is happening? So now this is the future value. Future value equal present value into 1 plus r into the power n. So with the continuous compounding, this is going to be a large number. It becomes very large. So we call in mathematically it is going to infinity. It's approach to the infinity. So go to the large number. So therefore, ultimately, this part of this formula is goes to the e base r n. E base e is a natural consonant value. In the mathematical things, I am not going to tell much more. Is a constant value. E is a constant value. It is always 2.71828. So the 1 plus r into the power n, this part is goes to e base r n. E always is a constant. E always is a constant. Its value is 2.71828. So with the continuous compounding, so future value for a single cash flow is equal present value into e base r is the rate of return, n is number of period. So that way you can calculate with the continuous compounding future value. So with the continuous compounding effective rate is equal, you can see if there is a continuous compounding effective rate is equal e into the power r minus 1. Right, so this has mathematically proven, but anyway, that this multiplication part is not relevant for you. So with the continuous compounding, what is the future value of this example? Then present value is equal e base r n. So how much the value? Our deposit is 300,000. E is a constant, that is 2.71828. R is 12%. N is 1. So how much the value is? So that is the future value with the continuous compound. That is the maximum with the theory of limit. That is the maximum approach value with the continuous compound. 300,000 into 2.71828 into the power 0.12. So we will get, what is the value? 3,300 38,000. 338,000. 249. This is the approximately, so you can get that. This is the approximately future value with the continuous compound. So then effective rate is equal 2.71828 into the power 12 minus 1. Effective rate is equal 2.71828 into the power 12 because our R is 12% minus 1. How much the effective rate? Effective rate 2.71828 into the power 12% or 0.12. From that, you have to deduct 1. 12%. 12.7. So I think approximately close to that one, 12.71. So that is the concept of continuous compound. Right? It is also can be with the if you deposit. I think in the practice continuous compounded deposit is not there, but anyway some applications are there like the continuous compound. So then yes. E is a constant value. In your calculator, I think that is there. Calculator YouTube पर लेते हैं ना ये calculator के pixel के can play e value में कितनी ना calculator के exponential की लाने किया ना this is always this. For the exam, I will give this number even. You need to have by heart. 2.71828 is the constant value. It's a natural constant value. Because that is a fix. You can see it's a special mathematical constant that arises naturally in many areas of mathematics, and it is used to describe continuous growth. Right? It is used to describe continuous growth. Approximately, this is the value. Right. Any questions so far? No. Right. This is about the future value of the single cash flow. Now we are going to the next present value of the single cash flow. Do you have any question? Voices are there? Right, Pashatino? Last row. Do you have any question? How about you? I'm going to take a question. Okay. What are your answers? Then think about it. And they will do it. So you can check the answers. Also better to have a scientific character, make scientific application. For the rest of the amount of our calculating. And make the answer. It is very I give analysis. Our ability answers they make it name continuous compounded answers they can there, but the answer is there. If there is a continuous compounded, this is the future value. No? This is the future value. 338,249 is the future value. Effective rate is same. 12.75. Same. Right. These are the answers for that other table values. Anything? What I got? Okay. So now we are going to the present value calculation. So you can see the now the job is easy, we can go fast because initially the concept you have taken in mind. When you calculate the future value the process is compounding. Now the process is discounting. So we calculate the present value here, right? For a single cash flow. When you calculate the future value for single cash flow, you can see the formula. Present value into 1 plus r into the power n. Now you want to calculate present value. So from the same formula, you can derive present value is equal future value into 1 over 1 plus r into the power n. 1 over 1 plus r into the power n. Right? 1 over 1 plus r into the power n. We are simplifying future value interest factor formula to the present value. Present value is equal future value into 1 over 1 plus r into the power n. 1 over 1 plus r n, you can rewrite if you need 1 plus r into the power minus n. 1 over 1 plus r n means 1 plus r into the power minus n. Calculate the 100 AC with the minus n. So you can remember this one also. 1 plus r into the power minus n. Minus, right? Minus n. Right. So now in this formula, this part 1 over 1 plus r n we term as present value interest factor. 1 over 1 plus r n we define, we label as present value interest factor for a r percentage and n period. Present value interest factor. That is the table number 2. I told you there is a 4 time value tables too. So this is the number 2. So again, you can take in the internet, you can download if all the textbooks in the financial management, these tables are there in annexes. Right? So this is that table. Present value interest factor table. Right, we come to this one later. If you are receiving 500,000 3 years from now, you are getting 500,000 from 3 years from now. And if your required rate of return is 10% per annum, what is the present value? What is the value of this investment today? You are receiving 500,000 in 3 years. So what is the worth of this investment today? That is the present value. So you can calculate by taking present value interest factor. Present value interest factor එකේ මේ expected cash flow එක වැඩි කරපුවාම අපිට එනවා present value. So present value interest factor you can calculate 1 over 1 plus r into the power n. Or here present value interest factor is equal, interest rate is given, මේව ලේසි ඔයාලට ඔක්කොම facts දෙනවා. ඔයාලට තියෙන just apply and calculate. So then present value interest factor is equal 1.1 into the power time period is 3 years. 1 plus r into the power minus 3. So r is 10% now. So 1.1 into the power minus 3. So how much the present value interest factor? 9. Factor 1.1 into the power minus n is the present value interest factor. වර්තමාන වටිනාකම් පොඩි සාධකය. Present value interest factor කීයද? 0.7513. This is the factor relevant to this required rate of return after adjusting for the time and the risk. So this is the applicable relevant factor. So now you can calculate present value of this investment. Present value interest factor multiplied by 500,000. So then value of this investment today is equal to 370 75,657. These are equivalent. Equivalent value. I make equivalent value කියලා කියන්නේ මේ value එකම ඉස්සරහට compound කරොත් අවුරුදු 5ක you are getting 500,000. They are equivalent. You are in indifferent situation. In 5 years, 500,000, no, if it is today, 375,657. අවුරුදු 5කින් 3කින් ලක්ෂ 5ක් හම්බුණත් එකයි අද 3,75,657ක් හම්බුණත් එකයි. They are equivalent. They are adjusted for the time. So therefore they are in equivalent level. So now if you look at this, this is an extraction of the present value interest factor table, right? Like in the future value interest factor, this is present value interest factor table. So what you can see, what is happening to the present value interest factor when time is increasing? What is happening to the present value interest factor? This is the last column is the present value interest factor. When the time period is increasing, what is happening to this? It's increasing. That is time value of money, because you know that money receiving today more valuable than money receiving tomorrow. Suppose that if you are receiving 1 rupee in 7 years from now, and if your equivalent of return is here 10%, what is the value of this 1 rupee today? If you are receiving 1 rupee in 7 years from now, and if your required rate of return suppose 10%, what is the value of this 1 rupee today? 0.51 cents. Time එක ඈතට යන්න present value එක අඩු වෙනවා. Time මුදලේ කාලය අඩු වෙනවා. So when the time is increasing, you can see present value is decreasing. Why? Mathematically, the process here discounting. Theoretically, reason is time value of money. Because of the time value of money. What is the time value of money theory? Money receiving today more valuable than money receiving tomorrow. So that is the time value of money. So you can see present value interest factor is decreasing. So therefore our diagram is now look like this. අරකේ අනිත් පැත්ත. Future value interest factor සහ time rate was positively related, but now you can see they are negatively related. Now if you look here, this is here in 10 years at this is 15%, 10%, 5% and 0. So present value interest factor at 10% here. Not 10%, yes, 15%. If it is 10% present value interest factor, in the time period you can see at the 10% somewhere here. When the time is increasing, present value interest factor is now if you take here, now this is 1 rupee. If you deposit 1 rupee today for the different rates, say for the different rates, now this is in 5 years, huh? Upcome with 5 years. In 5 years. So this one is 50 at the 15%, and yellow is 10%, 5% and the 0. If the 0% value so that is same. You will get the same 1 rupee for 15 years. Now at the 15%, sorry 5%. So this is the present value interest factor. Rate at 5%. Here they are the present value interest factor for the same 5 years. If the rate is 15%, you can see present value interest factor is here. So now you can see there is a negative relationship when the time is increasing. Present value interest factor it is decreasing. When the rate is increasing, 5%, 10%, 15%, likewise, then the rate is increasing. present value interest factor is decreasing. Reason is that, balance. Now here, present value interest factor is equal, present value interest factor is equal 1 over 1 plus R into the power n. Whether the n discounting, the process is discounting. So when the n is increasing, factor is decreasing. When the R is increasing, factor is decreasing. Because the process is discounting. It's like the opposite, compounding. 1 plus R into the power n. So you can see there are negatively relationship between n, present value interest factor, required rate of return or the discount factor, and the present value interest factor. Right. Now you have a small application of the present value and the future value of single cash flow. Look at this one. If you deposit 250,000 in the savings account that pays interest annually, you will have 380,289.75 rupees after 3 years. What is the rate of interest paid by this savings account? What is the rate of interest paid by this account? And also there is another one. If you deposit 75,000 in the savings account, which pays 15% interest per annum, compounding quarterly. How long will it take to account to grow for 226,310 and 0.40 cents? So this is application. These are the application of the present value and future value single cash flow. Try to do simple application. Now here, if you deposit 250,000 in a savings account, interest pay annually. We can handle timeline like this now. You are depositing today 250. And you will get 380,280.75 after 3 years. After 3 years. So what is the rate of interest paid by this account? How much the interest implied on this investment? So application of this present value formula or the future value formula. So now this 250,000 is equal to what? Present value. No? It is present value. This is the future value in 3 years time. So then you can apply either present value formula or the future value formula. So this is the present value. This is the future value. You can apply either present value or future value. So if I apply the future value is equal present value into 1 plus R into the power n. So now substitute the available things. Future value is 380,218.75 Present value is 250,000. N is 3 years. Interest is paid annually. No? Interest is paid annually, so that is 3 years. Now this is mathematics. So you have to solve this formula for R. How much that? So you can simplify this one. Make 250 only with the Muhammad. So you get when 250 divided by this 1.52 net. So then 1.52 equal 1 plus equal 1 plus R into the power 3. So then you can solve like this. In order to remove this 3, both sides you have to divide, you have to multiply by 1 over 3. So 1 over 3 means square root of 3. So square root of 3, 1.52 minus 1 is equal to R. So how much that? 15%. Answer is yes, 15%. Right. Go to the next one. You have deposit 75,000 in a savings account. You have deposit 25,000, 75,000 in a savings account. You have deposit 75,000 today. Account which pays 15% interest per annum. Compounded quarterly. 15% per annum, compounded quarterly. How long will it take for your account to grow? 226,300 days. Again, this is future value, present value application, so you can use any formula. So here, future value is equal to 226,310 for 0. Your deposit 75,000 today. So 1 plus R into the power N. But here, quarterly compounding is happening. So therefore, this formula you have to change from R you have to divide by M. N you have to multiply by M. To simplify the process here, I define a variable N into M is equal X, like this. To make it simplify the formula, I will define a variable N into M. So N into M is equal X. So therefore, instead of the n into m, now I substitute here x. R divided by m you can calculate because R is 15%. So 15% divided by m. M is how much? M compounding frequency per year. Quarterly 4 times. So you have to divide by 4. There are 0.14 some bindu at 0.0375. Right. So now I can apply here 1 plus R that 1.0375 into the power x. Into the power x. Right. Now solve this for the x. 226,310 divided by 75,000. 3.0174 is equal 1.0375 into the power x. Now what you have to do to find the x? You have to identify, you have to find this x. You might have different methods. Mathematics and finance debate. So I'm applying log. I convert this into log. So if I convert this into log 3.0175 is equal, when I convert this term to the log, it is first x log into 1.0375. So now x is equal this divided by log 1.0375. That is the x. This is the x. So how much x? Is it 30? X is equal 30. X is equal 30. 30 මොනවද? Here's the quarters. This is quarters. Because x is equal n into m. Now this is 30. 30 කියන්නේ quarters. N here, m here 4 times per year. So then අවුරුදු තුනක් කීයද? If it is quarters, answer is 30. If it is years, 30 divided by 4. 7.5. Years now, 7.5. අවුරුදු 7යි මාස ගාණක් approximately. So you can see 30 quarters.
Excuse me, madam.
Yes.
Can you explain that how we got this x number? That part it is not clear for me.
Yeah. Did you see the? Can you see the board?
Yeah. I can see the board. Yes.
So this is my way. I define the variable here using x because now there is a compounding, quarterly compounding. No?
Yeah, that area okay. That area okay. No, my concern is here that 109,301 divide from 109. This part I didn't get. And the calculation third step.
Log application.
Yeah. Yes.
Right. So now this one we cannot solve in this format. So we are converting this into log or log pure natural, what we call the ln log, whatever. So then when we converting this into log, so whatever we have convert this one, so this become log 3.0174 equal. When you convert this kind of value, now here 1.0375 into the power x. ඉතින් අපි මේක x වලට convert කරනකොට මේ power එකේ තියෙන එක it comes to first. අපි log වලට convert කරනකොට that is log rules. According to the log rules, so this power value is coming for the first in the term. So then x log 1.0375. So now you can solve this for the x. එතකොට අපි මේක x නේ හොයාගන්න ඕන. So therefore we take this here. So then x is equal log 3.0174 divided by log 10375. Are you okay?
Okay, madam. Now okay. Thank you.
Right. This is log converting, right? Cool. Okay.
Yes, madam. Now clear. Thank you.
What do you want? Make it this. This one. Leave this. What is the problem? Please come and touch the Galle. Then we can have this one. Please grab the more three. Shift the name in shift this one. Then after that, we will fix the 1.5. If the 1.5, someone like change, let me take the garden. अब शिफ्ट करके कितने लगा एक्स का हो गया एक तो वाला के टिश्यू में दिखेंगे थ्री शिफ्ट शिफ्ट थ्री शिफ्ट Okay, fine. So now this is the single cash flow. The next one is multiple uneven cash flow. Right? Multiple uneven cash flow. Make a complete. This is easy. Right. Now, suppose that for a multiple uneven cash flow, how to calculate future value, present value. Now the rule is okay. If you are going to the future, so the process is compounding. If you are going to the present, so that process is, if you are coming to the present, process is discounting. Now, suppose like this, there is an investment like this. This is not a single cash flow. This is not an annuity. Right? This is not an annuity even, not a single cash flow. In such a situation, you have no any path. What you have to do for the first time, the first time, you have to value this cash flow stream either to the future or to the present or any point in time. Initially, you have to value. At the very beginning, no any way, any path. One by one, you have to consider and you have to compound it separately and calculate the one by one value here, get the total. So that is the future value of the multiple uneven cash. If after that, if I ask you to calculate present value, so then no need to discount each cash flows again. Simply the value you received here at one shot, you can discount to the present. If I ask you to value for the year 3, either you can discount future value back by 3 years or present value you can compound to the forward by 2 years. So let's do that one through the understanding. So that is the way in the multiple uneven cash flow. There is no other method. You have to consider them separately. Right. Now here you are going to make above mentioned deposit in a bank which pays 10% per annum. It pays 10% per annum. So what will you have at the end of year 5? How much will you have at the end of year 5? So like this, calculate now. Now the concept you have received, right? 0, 1, 2, 3, 4, 5. So today, at the end of year 2, you are depositing 20,000, 40,000, 15,000, 65,000, and 80,000. So you are asking how much will you have at the end of year 5? Your recurrent rate of return is 10%. Right? It is 10%. So then, no way you have to compound each cash flows to here. How? What? This 80,000 you are depositing 5 years from now. So normally in the time value assumption, when I explain in the time value line, timeline assumption, I told you cash flows occurred beginning of normally at default cash flows occurred end of the period. So then this 80,000 end of year 5. This is end of year 4, end of year 3, end of year 2, end of year 1. So when you calculate in the future value of this 80,000, do we need to compound it again? No, you can take it as it is because this is end of year 5. So 80,000 අපිට කෙලින්ම එහෙමම ගන්න පුළුවන්. This is end of year 4. This is you have to compound by 1 year. Right? 65,000 compounding. So that means 1.1 into the power 1. So this 65,000 මෙතනට ගේන්න එක අවුරුද්දක් compound කරන්න. You have to compound by 1 year. This is end of year 3. To convert this 15,000 received in end of year 3 to the equivalent value of end of year 5. So you have to compound it by 1, 2. You have to compound it by 2 times. So 15,000 compounded for 2 years. This is end of year 2. From here to here 1, 2, 3. So that is you have to compound for 1, 2, 3, 3 years. 40,000 compounding for 3 years. So this is end of year 1. So this one you have to compound how many times? Here to be a 1, 2, 3, 4. 20,000